Welcome to the three-part series, 3 Ways to Generate Tax Savings from Charitable Giving. Today, there's many ways to give charitably, but figuring out which one's right for you and which one can save you the most tax money is important. Today, we're going to be talking about the Charitable Remainder Trust, how it can save you money in tax, how it can save you from the estate tax, how you can actually benefit from giving money today while giving it tomorrow. The CRT, or the Charitable Remainder Trust, is set up so that you put money into it, and when you pass away, the remainder, or whatever's in that account, goes to the charities. But you can reap some benefits while you're alive from that trust. Perhaps even more benefit than what you put into the trust. That's what we're going to talk about now. So for short, we call it the CRT. And essentially it begins with one person or a family that decides they want to give money. That's you over here. Excuse my drawing. That's the best I can do. You make a contribution to this trust or this account over here, which we will call the CRT, the Charitable Remainder Trust. And we call that a contribution into the trust. And in exchange, you get a tax deduction for putting money into this because it's a charitable tool. And then, of course, that trust is set up so that whatever's left in that account when you die goes to your charities, which we'll call C1, C2, and C3. However, there are actually many ways you can benefit from this while you're alive. Not only the tax deduction, but you can turn this back around and generate an income stream from it. And there's 2 ways you can generate income from the trust. The first way, we'll call it the CRT way. Stands for Charitable Remainder Unit Trust, where the income that you get from the trust is based off the performance of the trust. The second way is the CRT way, the Charitable Remainder Annuity Trust way, where you get fixed income from the trust. But it gets even better. You can actually preserve this benefit, not for yourself, but for your children. And you can peel it away, and instead of you getting the benefit, you can help your family get the benefit. However, there is one other way that you can benefit from a charitable annuity trust, or a charitable unit trust, or a charitable remainder trust. Essentially all the same thing with small differences. The last way you can benefit from this, instead of it going to your beneficiaries, or instead of it going back to you, you can peel some away and send the income stream into another trust. And we'll call this trust ILIT. It's a life insurance trust where the trust owns and pays for this life insurance. And the income you take from the Charitable Remainder Trust can be used to pay for the premiums. And then you can fund as much life insurance as you want based on the income from the Charitable Remainder Trust. Let's just say $2 million. And that $2 million could be worth even more than what you actually put into the trust. And when you pass away, this insurance trust will give your children or your spouse tax-free death benefit money. That's entirely tax-free. And then whatever's left in the Charitable Remainder Trust will simply go to the charities. Now again, like I said in the beginning, there are a myriad of ways to reduce your taxes through charitable giving. This is only number 1 of 3 ways I want to talk to you about. Next week, we're going to talk about the Charitable Donor Advised Fund, where you can group together all of your charitable giving from multiple years into a single year, get the tax break immediately, but not have to choose your charities right now. That's our next one. Ladies and gentlemen, if you enjoyed today's video, I highly encourage you to subscribe so you can get access to our future content when we post it. Or if you have comments or you feel that something could be improved upon, we'd also love to hear that. So with that said, we'll see you next week.